A bubble is truly created when everyone is bullish. So if you're bullish, the listener is bullish, and then they don't go up, and everyone's bullish, then that's a bubble.
People's definition of bubble is simply stuff that's gone up that I didn't buy, and I'm annoyed I didn't buy it, and therefore if I call it a bubble, it might come down. Hello, I'm Chris Beauchamp, Chief Market Analyst at IG, and today we are looking at influencers and how you can interpret what they are suggesting in the videos. Let's take a look at the first one.
You're investing for a long period.
Everybody's favourite money-saving expert.
And you have to look at it over the long period.
Do you know the government says he's cost them around at least £10 billion in lost revenue?
You want is to be forced to sell here because you need that money for, you know, the window that's been smashed in your kitchen.
A graph of cash versus global indices. Okay.
Here is this.
Talking about saving.
Only invest what you won't need for at least 5 years. You said 3, I say 5, some say 10. After clearing your expensive dets and you've got
so it's basic investing principles, okay.
Of 3 to 6 months worth of bills. That's the money you're investing.
Putting money away for the long term that you won't need.
Yet, I would say.
Very
Some
sensible.
would say go for it because you might win, but I'm more risk averse than that.
Okay, so this is Martin Lewis talking about investing for the long term, kind of what we said before about making sure you've cleared off all the expensive stuff first and you have the emergency fund. And then crucially, this is the important thing with stock markets, that the longer you leave money in the market, the greater the likelihood is that it will turn a profit and rise in value. Because the risk is on a 5 to 10 year horizon that you experience at least one decent market correction, market fall in that time of about 20%. On average, the market drops 14% in any given year. So if you need that money within the next year or so, you are obviously risking a significant drop in value, which you're not getting with cash. This is the point. If you want the money soon, then cash is the way to go. If you can leave it, allow it to compound, allow it to ride out those things, then you can put it more safely, I think, in the stock market. And what he was looking at there, of course, are trackers. So you're spreading that risk around, not putting it in a single stock or basket or small basket of stocks. Let's have the next video.
All night I've been making the case for my new investment.
Oh, it's Jim Cramer, everybody's famous, or everyone's favourite crazy investor.
Individual stocks and one non-stock.
Never quite recovered from the financial crisis.
This is all laid out, by the way, on how to make money in any market. So far, we've been talking about why it's worth picking individual stocks, but now I want to talk how you do it, as in what the heck are you supposed to identify the 5 stocks that are worth owning in your portfolio out of
because nobody's written this book before, but obviously with Jim Cramer's name on it, it'll do really well. Fair enough, I suppose.
Are stocks that
maybe he needs the money.
They need to be observable, meaning you can see what the companies do, and they need to be doing something that you're genuinely curious about. Is it really that easy? Of course not. But those are the first 2 questions.
It's kind of basic principle. I think it's John Templeton's idea of invest in what you know and invest in what you understand, which kind of Buffett says the same thing as well.
Owning. Believe me, you'll stop. Now, say you're getting started and you spot a company that jumps out as winner. You can feel it in your bones. But let me be blunt.
Oh, investing is gut feeling. That's never going to go wrong, is it?
Right here is where most people make the worst mistake. They somehow feel that they know more than the market does about a given stock.
Oh, nice. Pick stocks, not your nose. Maybe I'll try that one as a headline next time.
The truth is, you'll never know more than the market does unless you have inside information. But if you trade on inside information, you're going to go to prison.
You see, he has the knack of sometimes making it sound like a lot of hard work. Again, especially in an era of low-cost investing, of funds, it's never been easier for an investor that wants to put their money to work but doesn't know where to do it, to just assemble a portfolio that covers all the bases. You want global equities. It's a lot of US at the moment, but that's just because they're so large. You need perhaps a bit of gold, some bonds, and geographical diversification. I think with a lot of this, everyone wants to, well, not everyone, but people who want to invest often end up thinking they can pick stocks because it's more interesting, obviously. It's about trying to weigh out the various merits of a company, but it can be very, very tricky. Market history is littered with companies that just don't do as well as they should do, or the market just falls out of love with them as stocks. And so it's really hard picking winners. If you are going to start picking individual stocks, you need to have about 15 or 16 in your portfolio because that gives you diversification. And of course, they should be in different sectors. Okay, having 15 tech stocks, it might sound like diversification, but it's not because they're all essentially in the same sector. You need to have stocks that do, say, supermarket or a bank or a tech stock, an oil stock, a mining stock. So you've got that diversification. But in an era when an investor can call up quite a wide range of basic ETFs, you wonder how really that kind of advice is going to go down, because it's not necessary for most people. And yes, you might not do as well as you would investing in a few concentrated tech stocks, like say picking Nvidia 5 years ago. But the risk is that you pick a stock that doesn't do well. So okay, he's got a new book to flog, and he's got some choice lines in it. But I'm beginning to wonder about whether this kind of sort of stock market advice has a place now for most people. Let's take a look at the next one.
The original Dutch settlers in the New York area wanted to buy the island of Manhattan from the
Of course, it was called New Amsterdam when the Dutch landed.
For about $24.
When people hear that, they say, well, Indians kind of got taken because it's very prime land and great natural harbors and all of that. The Indians had
some stereotypical Indian photos. There we go.
Going to take this $24 and invest. And let's say the guy wasn't that great, but could do maybe 7% a year.
If you get a 7% return,
All right, so talking about compound interest.
So at 7%, it will take 10 years to double. So the $24 will become $48 in 1636 and $96 in 1646. And if you compounded at 7% a year for 100 years, you would have 1,000 times what you started.
But you'd also be dead, so there's the minor point there.
Become $24,000.
Especially in 1626, when average life expectancy was what, 40?
1826. And then we go another 100 years, you are at $24 billion in 1926. And then you go another 100 years, 2026, and you're at 24.
See, what you need there is a time machine to go back 400 years and put the money in, and then come back.
In Manhattan and extrapolate it out today, you would get to a few hundred billion.
And there's another way to kind of do this. Manhattan is about 626 square miles. This works out to something like 32,000 a square foot. Today, if you were buying pretty prime land in Manhattan, you'd pay about $1,000 a square foot for it. The Indians got overpaid at $24.
I don't think there's many people in the States who'd be prepared to make that argument. Oh, Einstein didn't say that, by the way. Everyone thinks he said that, but he didn't say that.
Thinking exponentially.
So there are three variables, right, which are interplaying with each other. There is the rate of compounding, there is the length of the runway, and there is the starting amount, the amount you start with. And you can actually massage these three. So if you know the interest rate, you know how long it takes.
So again, we are investing for the long term, talking about compounding.
Compounding rate should be.
We all did compounding in maths at school. But the important thing to remember is how it works in your favor over the long term. And that's the point of the video. It might be using an extreme point about buying Manhattan in 1626 and leaving the money untouched for the next 400 years, which I suppose is an optimistic assumption. But it is the importance of, I think we've said before, rolling the snowball. It's what Buffett talks about. The snowball gets bigger the more time you have to let the compound interest work in your favor. Einstein didn't say it. Everyone thinks he says it, or you see it quoted so often, but it is still an important point that over time you get the compounding interest of not just the return on your investment from the price return, but of course, if you're putting it in a portfolio of sensible, say what in the US they call blue chip stocks, what we tend to think of as FTSE 100 stocks, or indeed similar large cap stocks around the globe, they are paying you a dividend as well. So you're not just getting, say, 5, 6, 7% in the actual price return, but you're getting 2, 3, 4% in dividends. Now, that doesn't sound like a lot, but over the course of time, that can make a huge difference. In fact, if you look at investing history, most of the returns, or those really strong returns, come from letting those dividends work. And when you reinvest those dividends, i.e. you don't take out the cash if you're paid 4% a year on investment, you put it back, you buy more of the stock, you buy more of the fund you're using. So that helps the pot grow even faster. And that point about starting capital, I think people obsess a lot over this starting capital, especially now in an era of low-cost investing in ETFs. Oh, I need a certain amount to start. You don't. What you need, and they talked about this in the video, is what they call the runway. If you've got the 30 years, it really matters very little how much you start with. The important thing is letting that run. And even if you start early enough in investing, if you had the cash, you're fortunate enough to have the cash to start in your early 20s and just put something aside, you wouldn't even need to keep investing that same amount every month well beyond your 40s, because you've built up enough of a nest egg, enough of a fund to just let that compounding then work in your favor. Of course, that's the irony, that when you need the money most is when you should be putting it to work for the longer term. But if you can find that money, it doesn't matter so much whether it's £100 or £1,000, really. It sounds like a big difference, but over the course of 40 years investing, the difference is minuscule. What the real returns come from, as they talked about in the video, is the compounding, the 7% a year, and indeed the dividend you get on top of that as well. Finally, let's look at the last one.
This is the most hated V-shaped rally. Most of our Zooms with our
Oh,
institutional
is it
clients
Tom
is
Lee?
people telling us why the stock market shouldn't be
great
going
stock
up
market
and
bull.
why it's expensive. And every time we get off, it strengthens the case for stocks to go higher because it's a non-consensus view that we should be going up. You need skepticism.
Tom Lee's famous, of course, for
markets to
being
go up.
firmly
If
bullish over the
everybody
last
was
couple of years,
bullish in
and
the
he's
liquid
not been
world,
wrong to give
that's
him
the
his
top.
due.
Just because digital asset treasuries have gone up and you don't own it doesn't mean it's a bubble. A bubble is just your
Which is
friend
one of my
making
favorite
money.
topics,
A
bugbears. What is a bubble?
truly created when everyone is bullish.
Yeah.
So if
I
you're
think he's
bullish,
right about bubbles.
not you, but I'm saying the listener is bullish, and then they don't go up, and everyone's bullish, then that's a bubble.
Tom Lee has become famous for saying, or famous at least in market circles, to be fair to him, that the market should keep going higher, and he has not been wrong. And he gets quite a bit of stick for it, but his point stands that investors aren't short of reasons to worry about the stock market. If you look at valuations, the US stock market is the most expensive it's been since 2008, if not 2001. And those scary years mean that people immediately start to think, well, we're overdue a market crash. Perhaps we are in simple year terms, but markets don't crash for no reason. They don't crash simply because it's been a while since the last one. And you can go into a long argument about why US stocks are expensive. Do they deserve that valuation? Does it mean you should be cautious about them? But I think the reason why they're expensive is if you look at things like profit margins, they're just much stronger than the other part of the globe. So the FTSE 100, the DAX, the Nikkei, the Hang Seng, they're full of good companies, but it's just the profit margins are just stronger in the US. So that's why you're kind of paying for the quality in the S&P 500 and the NASDAQ. And yes, they're expensive, but you have to have a reason for a market crash. And the problem is, I think, for a lot of investing advice or suggestions at the moment is that people are saying, well, you have to be cautious of the market at these levels. Yes, you do. But the risk is that markets continue to rise over the next year. And as Tom says, because everybody's coming up with these reasons why they're cautious, then actually that's a sign that it isn't really yet a bubble. The thing about 1999, when it was properly a bubble, was that everybody thought it would continue to go higher. These companies would change the world. They did in the end, but in the short term, so many of them went bust because the business model didn't work and their valuations have been bid up to ridiculous levels and they simply weren't generating cash. The big US tech companies now generate vast amounts of cash, and that's why it's not really 1999 all over again. I'm a big fan of, as Tom says, the idea that people's definition of bubble is simply stuff that's gone up that I didn't buy, and I'm annoyed that I didn't buy it, and therefore if I call it a bubble, it might come down, and it's my rationalization for not being in it. And so the word bubble, I think, gets banded around too much. And his point is there. If everyone suddenly turns bullish and markets really do take off, that's when we move into bubble territory. Thanks for joining me on this episode. Don't forget to like and subscribe for more.